Hi, Martin Turner here. This is our last week's lecture, and arguably the most important. I first give some introductory remarks. We then revisit ratios as well as net present value and internal rate of return. And finally, we reflect on what management accounting is. Let us start with some introductory remarks. Hi, Martin Turner here, and welcome to the Week 12 lecture for ACCT11059, Accounting, Learning and Online Communication. Today we're looking at ratios revisited and assignment 2 discussion. I am sad the term is coming to an end because I feel I'm starting to learn, not just a read and forget type of learning, but a deeper learning. Some people are communicating to me that they're feeling like they've done some, they're just starting to get going in the learning. You know, it's new university, getting used to a lot of things. And it's easy to fall, in formal education, it's easy to fall into a read and forget type of learning. You know, you're just going through the motions. But a deeper learning where some people are feeling like maybe I'm getting hold of some of these things. So some people are reflecting on their learning, which is part of what we're looking at in this unit. I need to have more confidence in myself. So a number of people are growing in their confidence in their capacity to learn. My confidence has taken some big hits over the years. So a lot of people are having to build their confidence in their study and in lots of new changes. And attending CQU, however, the longer I am studying and attending CQU, I believe my confidence is slowly returning. I've noticed this with a number of people. Your confidence is building. Yes, I can do this. At first, a lot of people were nervous at the beginning, and that's pretty natural. But people are realizing, yeah, I can do this. And I love this unit and I want to learn more. So the number of people are getting a bit motivated in terms of their study as well. And that's an important thing to start with in your degree and to continue through your degree to the end. I also teach a capstone unit in the Bachelor of Accounting. So for those who are studying accounting, I see you at the end of your degree as well. So you can start to, so I see how you've gone through your degree too. So what are we doing today? We're going to revisit ratios and then also revisit NPV and IRR. So these are key aspects of assignment 2, steps 7 to 10. Then we're going to look at management accounting and complete our look at management accounting, and then we'll have a minute paper. Ratios, profitability ratios, net profit margin, net profit after tax to sales, and return on assets, net profit after tax to total assets. So you use net profit after tax, don't use comprehensive income. So it's your net profit after tax, and sales is your revenue or sales figure. Most people find these fine to calculate. Then you say that's profitability. How much money is my firm making? That's net profit after tax as a proportion of its sales. So say for every $1 of sales, how much net profit is it making? That's the net profit margin. Or how many dollars of total assets I have invested in the business am I making profits on? Now, efficiency or asset management ratios. So you've got the total asset turnover ratio, which is your sales to total assets. Turnover is sales. Turnover is another word for sales or revenue. So the total asset turnover ratio is your sales or turnover to total assets. So it's how much sales your firm is generating for each dollar of total assets it has invested in the business. And your liquidity ratios, current ratio, current assets to current liabilities. Most people find that fine too to calculate. And then your financial structure ratios, your debt to equity ratio. That's your debt to equity. Debt can be total liabilities to equity. Some people use the interest paying liabilities, which is also fine, but most people use total liabilities to equity. And then your equity ratio is your equity to total assets. So all of those are out of your financial statements, in your financial statements worksheet. And the key thing is to link them. So when you're doing, for example, your net profit after tax to sales, your net profit margin, you go in, you go plus, go to net profit after tax in your worksheet, press do divide, then go to sales, press enter, and you've linked it. Then you just drag it across the other columns and it's done. It doesn't take long to do your ratios. You can do them during the tutorial, for example, without any trouble. And then you can ask questions as you go. Then we have the market ratios, earnings per share, net profit after tax to number of shares. Where's the number of shares? Well, you typically can find it by going to the footnote, go to your equity section in your balance sheet, in your annual report, go to the footnote, go to issued shares or some similar name within your equity, and go to the footnote that relates to that, and it'll tell you the number of shares. So you can find the number of shares each year and put that into your spreadsheet, the number of shares. You can just do it in the working section in your in the worksheet where you calculate your ratios. Now, a trap for young players is that with ratios, you need to compare like with like in terms of magnitude. If net profit after tax is in dollar thousands and your number of shares is in actual number of shares, the ratio isn't going to work. People will discover that pretty quickly. The order of magnitude is different. If your net profit after tax is in thousands of dollars, then your number of shares needs to be in thousands of shares. So you need to divide the number of shares by 1,000. If your net profit after tax is in millions of dollars, then your number of shares needs to be in millions of shares. So you divide by 1,000,000. And then the price earnings ratio is your market price per share divided by earnings per share. So where are you going to find your market price per share? Well, you can Google it. Just as I Google Ryman Healthcare share price, you can go your company's name, share price, and you'll find it. And put that into your spreadsheet. And then you can link it to the price earnings ratio, do it in your working space in the spreadsheet. And then you can use your earnings per share, which is a ratio you've already calculated. So that's your market ratios. Then you have the ratios based on your restated financial statements or your reformulated financial statements. Return on equity is your comprehensive income divided by shareholders' equity. I put average there, but you can just use closing shareholders' equity or average. I've used average at Ryman Healthcare. Your comprehensive income is in your restated, it was in your financial statements and your shareholders' equity. Then return on net operating assets is your operating income, OI. That's from your restated financial statements and your net operating assets. Again, I put average here, but most people will use closing. Net operating assets, again, from your restated financial statements. Your profit margin, operating income after tax divided by sales, operating income from your restated financial statements, and asset turnover is sales divided by net operating assets. Again, your net operating assets is from your restated financial statements. And for people who might have some trouble with their restated financial statements, I can help you with some of those numbers so you can use them in your ratios. So they're the ratios based on your restated financial statements. Now, as well as your ratios, there's the internal rate of return and NPV that we're looking at. These are just examples of some of the financial formulae that are in Excel. Excel's got a lot of financial formulas. So NPV, net present value. So you're going to calculate that in your assignment. Here it is just in long form. You can see that in this example, we say $100 investment today. So I've got it in brackets. That means negative. I pay $100 today, and then it returns $100 in year one, $100 in year two, and $100 in year three. So I get a total of $300 back for my $100 in. But the NPV is not $200, which would be $300 minus $100. It's not that, because it's $148.68, as I've calculated. And that's because we discount the cash flows that are in the future, year one, year two, year three. The $100 at the end of year one, we discount by 1.1. I've got a discount rate of 10%, and that's 1 plus 10%, 1.1 0.1 is 10%, but we use 1.1 because we are discounting back. 100 divided by 1.1 is $90.91. In year 2, it's $100 divided by 1.1 squared, which is $82.64. And in year 3, end of year 3, the $100 is 1.1 divided by 1.1 cubed, which is $75.13. Add all that together, you get $148.68. So you can see that the $100 I invest today is $100, but the $100 I'm expecting to get in the future is discounted back by the discount rate. A big part of that time value of money, which says that money in the future is worth less to me than money today. It's expected money in the future. Money in the future is expected. It's not real yet. You haven't got it. You may get the $100, but it might be different. It might be less. It might be more. That risk, the risk of the future, that's the big part of why we discount back. Other reasons can be inflation. They might be expecting to have a little bit of inflation. We might be also money today we could put in the bank and perhaps get a little bit of interest or something, reasonably risk-free. So that's also part of why money is worth more today, but the main part is the risk. The expectations of future cash flow in the future is risky. And the internal rate of return is the discount rate that results in NPV equaling 0. Now, when an NPV of an investment equals 0, that's the internal rate of return. And both for net present value and internal rate of return, we use expected future cash flows, not expected profits. They can be very different. We saw that with the purple chocolates example in a previous class. Internal rate of return and net present value is about cash flows, expected future cash flows that we discount back. And we adjust the expected future cash flows for the time value of money. Now, the Excel formulas, these are financial formulas. There's a whole heap of them in Excel. We're looking at the NPV function. It calculates the net present value of an investment by using a discount rate and a series of future cash flows. So the NPV, we put in the discount rate, which I've used 10%, so 0.1. So we put 0.1 in. We don't put 1.1 where we're compounding. We just put the 0.1 or 10%. And then we put value 1, value 2 each year of the future cash flows. These future cash flows occur at the end of each year. We don't put in the initial cash investment. The initial investment's often made today. We often have to, a lot of investments, we have to put money in today to get a return in the future. The NPV calculation using Excel is based only on future cash flows. So we don't include the initial investment in our NPV calculation. And our investment today, we then deduct from our NPV result using Excel. So you get an opportunity to practice that in your spreadsheet. Now, the initial investment is put in as a negative number. It's a negative amount, something we pay out rather than receive. So we put the future cash flows and the discount rate into the NPV calculation in Excel. We get a figure, then we deduct the initial investment. So if the discount rate's 10% each year, the initial cost of investment today is $10,000. The future cash flows are year 1, $3,000, end of year 2, $6,800, end of year 3, $6,800. If we put all that into Excel, the NPV is $3,456.05. So it's a positive number. Now, for the Excel buffs, you can switch between viewing the results and viewing the formulas in each cell by pressing Control+ with grave accent. You can see it up there. Or on the Formulas tab in the Formula Auditing group, click the Show Formulas button. So people can flick between the result and the formula in any cell. You can see this. You can just check how you're calculating different formulas. That's for the Excel buffs. For the young players, there's an important tip. There's a trap for young players. Do not include the initial $10,000 cost as one of the values in your NPV formula, because a payment occurs today at the beginning of the first period. So there's no discounting of that initial investment. Instead, you subtract it separately from your NPV calculation. Now, that's the key thing to remember with the use of NPV in Excel. Now, with the IRR, with the internal rate of return calculation in Excel, you put in the values and then a guess for the internal rate of return. Now, the values are the cells that contain numbers for which we want to calculate IRR, and it'll have at least one positive number and at least one negative number. And you include the initial investment in your IRR calculation. So that's different to the NPV calculation. And the guess is the number we guess to be the IRR. Now, how Excel calculates IRR is it uses an iterative technique. So what that means is it just calculates the NPV again and again and again until it gets to an answer of 0. And it will start with our guess. So say we put in 10%, it'll start with that. And if that's, and it'll cycle through a calculation until it is accurate within 0.00001%. And if it cannot find a result after 20 tries, it gives you the #num exclamation error value. Now, if you don't include a guess, it's assumed to be 10%, 0.1. So it'll just start with that. So you don't need to put the guess in. And it'll go back and forward. So it'll put in the 10%. If that's a positive NPV, it'll try something a little bit higher to get down to 0. And then if it's negative, it'll use something a little bit higher to get lower to get to 0. If IRR gives the #num error value, or if the result is not close to what we expected, try again with a different value for our guess. So you can have another go with a guess that will help it get close to it. So here's an example. $70,000 initial cost, future cash flows, year 1, 15,000, year 2, 18,000, end of year 3, 21,000, end of year 4, 26,000, end of year 5, 26,000. Put it into the IRR for NPV. You put all those cash flows in, and it comes up with an internal rate of return of 14%. So in other words, at an internal rate of return or discount rate of 14%, the NPV is 0. And remember, we include the initial $70,000 cost, it's a negative number, as one of the values in the IRR formula. This is different to what we do with NPV. Now, the internal rate of return has the advantage that it's easy to understand. Internal rate of return, 14%. Another investment internal rate of return is 15%. Well, we understand what that means. We understand what a return is. So 15% sounds better than 14%. However, and that works fine if you just have one initial investment, but sometimes investments can involve a couple of investments. You might have an initial investment and then you have to put in some more money in a few years' time. If you have more than one negative cash flow in your internal rate of return, then you can, in your investment, you can get more than one internal rate of return, because it's just the way the formula works. There's sort of two areas where it can go to 0. And that can really confuse people. And also, it doesn't take into account how much is invested. So you get a 14% IRR that you might have invested $1,000, you might have invested $100,000. And so when you're comparing investments, a $1,000 investment might get 15% IRR, a $100,000 investment might get 14% IRR. How do you decide what you want to do? If you can't do both, you might prefer to do the $100,000 investment because you're going to make more money than with the $1,000, even though the IRR is slightly lower with the $100,000 investment. Now, the net present value just gives you $1 of added value, not a percentage return. And that can be confusing to people. Your NPV is $100. What does that mean? Whereas people can understand a percentage return. But what it means is it's the dollars of added value in today's dollars, in your discounted value calculation, you've got, by making this investment, given all the assumptions I've got in the model, the NPV calculation, I'm making myself, say, $100 richer today. So it's the value add, given all the assumptions. Some of the issues with net present value is determining the discount rate. That can be difficult. Whether you put 10%, 5%, 15%, that can make a big difference to your NPV calculation. Where does the discount rate come from? How do we determine that? There's a lot of judgments involved in doing that. There are also difficulties in forecasting cash flows. This applies to internal rate of return as well. So there can be a lot of judgments involved in coming up with the cash flows over the next few years, particularly as you get further out. And then there can be technical difficulties with the NPV as well. One of the issues with the NPV calculation is it assumes that we reinvest the cash flows each year. So I might get $100 in year one, $100 year two, $100 year three. The way the net present value works is it assumes reinvestment of the cash flows to the end of the period. And that may be difficult. You might be getting the cash flows out each year, but you may not be able to reinvest them at the same sort of return that you can, that investment. So that's the internal rate of return and net present value. So you're just being introduced to these concepts along with payback period in this unit. And you can see that in Excel, it has a lot of capacity to do financial formulas like this. Now, management accounting. We've been looking at management accounting in the back part of this unit. And we're going to wrap up with what is management accounting. Some people like to be told what it is at the front, some simple definition. Well, what is management accounting? A number of people have been thinking about this. Management accounting, it is about much more than just numbers. This is a big insight a lot of people are getting about accounting. When I started this unit, accounting to me was just about numbers. You know, you're just balancing everything out, doing the numbers. I now know there is a lot more to it than this. This is a key insight. Accounting is more than just numbers. Let's have a look at what all that means. Management accounting, here's a definition, is concerned with the provision and use of accounting information to managers within organisations to provide them with the basis in making informed business decisions that would allow them to be better equipped in their management and control functions. We could have just started with a definition like this, but it's a definition of management accounting, but what does it mean? And you might be able to make a bit more sense of that now. It's designed to provide information to managers to help them make better decisions and both to plan and control functions within the business. And we've been looking at whether accounting can help or hinder these sorts of things by managers. Now, we've seen that management accounting information is usually confidential. Our firms keep it to themselves. Ryman Healthcare doesn't give out a lot of its management accounting information. And it is used by management. It's not publicly reported like the financial accounting. It's forward-looking instead of historical, typically. So managers are interested in making judgments about what's going to happen in the future. And there can be historical information, but there's also, we see there's budgets, forecasts, estimates about the future as well in management accounting. It's pragmatically computed instead of complying with accounting standards. There's no rules for management accounting. So it's just what is going to be helpful to make decision-making easier. We did see that because there's a lot of rules around financial accounting, if your firm, like all our listed companies are, if your firm is producing general purpose financial reports, to the public, they have to follow certain rules. And so it's often easy just to follow those rules within the accounting system, management accounting system as well, so that we don't have two systems. So often we are complying with a lot of the accounting standards within our management accounting if we're a listed company or a company producing general purpose financial reports. But we don't have to. Used within an organisation typically for decision making. So management accounting is for internal use. And it's for making decisions, specific decisions in aspects of a business. I feel I can understand the concepts we've been learning, and I'm able to apply them to real world situations such as with Ryman Healthcare. So some people are feeling this, feeling that they've been understanding the concepts we've been looking at for themselves. And when you understand something, you can apply it in the real situations, which is what you're going to need to do after you graduate in whatever area you are. In accounting, whether you're studying accounting in your degree after this, or whether you just got, this is your bit of accounting, just as you're learning all the disciplines and you'll specialize in perhaps a different discipline than accounting, you need to be able to apply what you're learning to real situations. And so we've been doing that with Ryman Healthcare, and you've had the opportunity to do that with your firm. I believe it is understanding a business that makes for a great manager. So a great manager needs to understand the key aspects of the business, what's really going on. Understanding not only the how and the why, or understanding quantitative information, but also having a deep understanding of qualitative information that affects a business. So there's shades of grey as well as the numbers. My first thoughts were managers are indeed driving firms. So some people thought that initially, and others thought maybe managers don't really know what's going on. But quite a lot of people thought, yeah, they are driving firms. But now I have a deeper understanding of what that means and how important it is to ensure managers are given realistic and reasonable information. So we saw, for example, with allocation of cost to cost objects, particularly to products, how well that's done. It can influence how realistic and reasonable the information is that management are being given. They're working out contribution margins for various products, the sales, the variable costs, how well those information is put together is important to supporting decision-making by management. Otherwise, incorrect information will not help a manager, but will hinder a manager instead. So accounting can hinder if it's not put together well. A big part of this I've come to realise is the management accounts. In some cases, the management accounts could be the only source of firm information. If you've got a larger firm too, you can't get around everywhere. You're largely managing by numbers from the management accounts. If I owned a business, I would ensure the manager had the qualities to drive my business, someone who had great people skills. So some of you will be learning about some of that in your studies too. Someone who had great people skills and who will inspire others in their work. Leadership skills, because a business is only as good as its people. And in some businesses, that's all you got, it's people. A person who is not afraid of taking calculated risks. Good people skills, able to make judgments about the risks in the future. And most of all, someone who can interpret correctly the management accounts so they will make appropriate decisions. Most of all, someone. So why is it that so many senior managers of businesses have accounting backgrounds? Because if you've got a business, you want someone who can interpret correctly the management accounts so they can make appropriate decisions. Otherwise, they could be going off and doing all sorts of things. So let's have a look at let's hop onto Socrative, and we'll have a look at what was the most important thing you learned today and what questions remain unanswered. So let's have a look. Hop onto Socrative. Keep them coming in. Imogen in Melbourne. How there can be more than one internal rate of return. The most important thing you learned today, Imogen, was there can be more than one internal rate of return. Why was that important for you, Imogen?
It just gives me like a different aspect. Like now I know that there can be more than one, so I can look at it going, where are the other ones?
Yeah, that's only if you only have one initial investment, there'll only be one answer.
Yeah, right. Exactly.
But if you've got more than one negative, quite a few investments, you put a bit in and then, I've got to put a bit more in, say in year 3. well, then you can
Yeah.
have more than one answer. It doesn't mean it'll come up when you do IRR in Excel. It'll zoom in on one of them, and that answer might be fine. It might be 12%, but then it could, if it started off, it might end up with a completely different answer somewhere else. And so, yeah, that really throws people. So, yeah, that's good. So you can see there's a lot of technical skills. All that is indicating is there are a lot of technical skills with using these concepts like internal rate of return, NPV, to interpret the answers. It's not just a press the button and do it. There's a lot to know, and I'm just giving you a little bit of a feel for that. But as you develop your skills, particularly if you're going down the accounting route, you can build your skills with there's a lot of technical skills. That's good, Imogen. Kim in Atherton, revisiting that NPV and IRR are about expected future cash flows adjusted with the time value of money. That's excellent insight. So that's the key thing to know about NPV and IRR. They look at future cash flows, expected future cash flows. And accounting can help to generate those future cash flows if we've had experience of doing things before, like Ryman Healthcare has built a few retirement villages in the past, got a pretty good idea of some of the cash flows that can be involved. So when it is analysing potential new investments and different options they've got to develop a property and so forth into retirement village, they can draw on their past experience to help them develop their expected future cash flows. And we adjust it with the time value of money because of the risk. And some investments will be more risky than others, so we'll have a higher discount rate for some than others. Sophia in Brisbane, that I'm not the only one feeling like I'm just learning something now. Plus the recapping is helpful to make sure I'm on the right track. So Sophia, you feel like you're just learning something now. What do you mean? Mic not working. Fair enough. Yeah, so a number of people are feeling like that. It can take a while just to get settled into studying at uni and all the other things you've got going on. And a lot of people have been coming into the country gradually too. There's been delays for people, or just coming to a new country, or moving, or all sorts of things going on. And so, yeah, just getting into learning how to learn. The recapping is helpful to make sure I'm on the right track. Yeah, so we just sort of recapped management accounting particularly, and also looked at some other things for assignment too. Revisiting the ratios to understand the importance of ratios, which helps us to look at a business through the numbers. Anita, yeah, we look at these ratios a lot. It's various in every business, so choose the best for you. That's right. So different businesses look at different things. Contribution margin. Contribution margin equals sales less variable costs. Remember that. That'll be useful. And so you'll be looking at all sorts of figures around different products, different aspects of a business. We've looked at the concept of cost objects and how we can use various ratios as well for a whole business or for different elements. And think before make a decision, just like our life. That's right. So you need to use judgments. It's not like paint by numbers. You've got to interpret the numbers. You've got to understand how the numbers got put together and be able to interrogate them and check and inquire as to whether people are telling you stories or not. So there's some very interesting insights that people have got. And just at the end of a class or end of reading something, anything, you can ask yourself, what was the most important thing I learned? And just write it down. The writing of it down is really helpful. It only takes a minute to answer these two questions. That can really increase your learning from that situation. What questions remain unanswered? Imogen in Melbourne, none. All my questions were answered. Sophia, none. Thank you for being my lecturer, Martin, for my first accounting class. Thanks, Sophia. That's right. It's your first accounting class. And for those studying accounting, there's a lot more ahead. And for those who aren't studying anymore, you've got some foundational concepts that you can use throughout your career. You'll need to know something about accounting. Trust me on that. And just as everybody will need to know something about all the disciplines. So for those studying accounting, for example, you need to know about all the other disciplines too. So that's why you get an introductory subject across a range of disciplines. Anita, Do I really have to use those ratios if I work in an accounting firm? Like if I work in an accounting firm, well, what people want from accountants in accounting firms is advice. That's what they want. They want you to be able to interpret the numbers and tell them and really give them some advice about what they need to do. And before things happen, give them some sort of warning. Increasingly, with everything going on to the cloud, accountants can give advice just in real time. They can just keep track of people's accounts in real time and say, look, there's this issue coming up, particularly often around cash flow and so forth. So whether you use ratios or just numbers, but often ratios tell you a lot because any ratio is telling you the relationship between two items in the accounts or between an item in the accounts and something else. And that can often tell you a lot. It's a bit like the profit margin tells you your net profit after tax to sales. So your profitability per sales, if that's starting to shift around, that might be telling something. And you might need to be looking at things like your pricing of different products, or whether you need to be getting your costs down somewhere, or whether you need to be changing how the product in some way. So the ratios, these are just some ratios, some common ratios we've used, but there are a lot of others. But the key thing I needed to know about ratios is they're not a cheat sheet thing. It's not just an answer. Like some people seem to think some ratios are good and others are not. It depends on the business. A business that's growing strongly, like Ryman Healthcare, it might have negative free cash flow. And some of its ratios mightn't look that good, but it's growing its business and it's making a lot of economic profit, for example. But other businesses might be more stable. They're not growing strongly, and so the ratios might look better in various ways. So you've got to interpret the ratios based, on the business. Did that make sense, Anita? Did you want to have a follow-on question?
Yes, all good now. Thank you.
Is that all right? Yeah. So, all you're getting is a little bit of a start, and there's a lot more to know. That's great. All right, well, that's what everyone's got. So today we revisited ratios. We looked at some of the ratios, a few little tips on calculating them. Everybody facing the same issues with their ratios. So if you have any difficulties, you can just ask people on the Facebook page. There's lots of answers to questions. You can search by keywords. You can find out everything, really. NPV and IRR we revisited, just had a bit of a look at it, just saw some of the issues with it. Was it Anita who said it's about, or Kim said it's about the future free cash flows that we discount back to the present? And so it's various technical issues around it that you can get better at over time. And then we had a bit of closure around what management accounting is. And just like financial accounting, management accounting is not about the numbers. It's about what the numbers tell us about the business. We need to be curious about business. If you're curious about what business and are interested in it, and you are using the numbers to help you find out what's really going on in the business, you'll be streets ahead of the average graduate. So easy to get trapped. It's so easy just to get into the numbers and just find them really interesting, the numbers themselves. But we're not interested in the numbers, we're interested in what they tell us about the business. All right, well, thank you very much, everyone. It's been great having you through these 12 weeks. I know there's a number of people who are working flat out really to catch up and finish their assignment too, and many other things possibly at the end of term. Others are further along in their studies, which is good too. I've enjoyed working with each of you through this term, and also through the next period as you all complete your assignments and complete your work. It's been great having you with you, and a number of people have done some great learning, and wherever you're at, are getting some grip on what accounting is, which is great. and also how to learn, and also about some of the issues with online communication that we all need to get on top of. Well, thank you very much, everyone, and bye for now.